You know, everybody who's following the Japanese carry trade has seen headlines like this.
The Japanese yen just crashed to its weakest level against the dollar in 40 years. Not 10 years, not 20, 40 years.
The Japanese carry trade is a black swan that's about to wreck your life. And you know, it's really not a black swan. It's just that everybody's too darn scared to talk about it, which I guess makes it not a black swan. Let's go talk about this thing. Here's a thing that nobody's saying out loud. The Strait of Hormuz has been closed since the end of February. That's over 5 months. Japan already took the hit, and hard. The Bank of Japan already hiked rates to a 31-year high. They already ran an emergency currency intervention with the United States, the first joint one in 15 years, and the carry trade still has not blown up. So, either this thesis is wrong, or something's coiling instead of breaking. And I think it's the second one. And I want to walk you through why. Fun fact, just last week, the Strategic Petroleum Reserve dropped below 300 million barrels for the first time since 1983. Before the February war even started, it was sitting around 415 million. We've burned through over 100 million barrels of the reserve since this thing has kicked off. And there's still no end in sight on Hormuz. I've already told you I'm doubling down on oil. The reserve's draining, and the government's running out of supply it can release to keep the prices from spiking. And the caverns themselves can only be drawn down so much before you start doing permanent damage to them. That's the SPR side, and it hasn't gotten better since the last time I talked about it. It's gotten worse. 300 million barrels, lowest since 1983. Let's call it what it is. We are close to the actual bottom of what this country can pull out of the ground in an emergency. I'll be honest, this whole thing has enough moving pieces that I actually ran it through Gemini myself a few days ago, just to stress test my own thinking before I brought it to you. Same way I've already told you, I check multiple sources against each other on this stuff, not just one. It came back and told me Japanese carry trade unwinding was virtually 100% likely once Hormuz closed. It's a strong claim. So I went and checked it against what actually happened, and that's where this gets interesting. But before I get into that, there's a second piece to this I haven't gone deep on yet, and it might actually be the bigger deal. It's Japan. Japan gets about 95% of its crude from the Middle East. Something like 93% of that moves through Hormuz. There's no economy on Earth more exposed to this specific choke point than Japan is. And it's already showing. The crude imports dropped by 47% between March and May compared to a year earlier. Here's the mechanism. It's actually pretty simple once you see it laid out. Hormuz closes. Japan has to pay way more for the oil it's still getting. That shows up as inflation at home. The Bank of Japan gets forced to raise rates to fight it and defend the currency. Higher rates plus a stronger yen would mean all the money that's been borrowed cheap in yen to buy stuff like US stocks or riskier bonds overseas, that trade stopped working. People would have to sell what they bought to pay back the yen they owe. That's the carry trade unwinding. And if that liquidation hits, it wouldn't stay in Japan. It would rip through global markets because that borrowed yen is still sitting inside tons of other trades everywhere. Why does this matter to somebody in the US? Because we're actually insulated from the first part. We produce our own oil, but we're not insulated from the second part. If Japan's currency situation forces a global unwinding, US stocks get sold right along with everything else, no matter what else is happening with gas prices here. Now here's where it gets interesting. Every single piece of that chain I just described, it's already happened. Hormuz closed. Japan's import bill exploded. The Bank of Japan already hiked to 1%, a 31-year high. And 2 weeks ago, the US actually ran a coordinated intervention to prop up the yen. First one between the two countries in 15 years. The dollar was trading at 163 yen right before that, a 40-year high. They stepped in and knocked it back under 160. And where is it sitting now? It's already given back about half of what that intervention brought, slipping back towards 160 within 2 weeks. So the crash everybody's calling hasn't shown up, even with the fuse already lit. The emergency lever already pulled. Why? Turns out there's a real answer. And it's not just the Bank of Japan's being careful. When the US and Japan did that intervention, the US Treasury didn't sell dollars to buy yen. They sold euros. Kind of weird. And it wasn't an accident. Here's why that matters. If Japan had to raise dollars the normal way, they'd probably have to sell US Treasuries to do it. And a forced Treasury sell-off pushes US bonds higher, which hurts Washington's own borrowing costs. So Scott Bessent has been pushing the Fed to expand a facility that lets Japan raise dollars by borrowing against Treasuries instead of dumping them outright. Why would they do that? Because this was never just about saving Japan's currency. The US was protecting its own bond market at the same time. So that's a real concrete reason the unwinding hasn't fired yet. Not just the Bank of Japan moving slowly or political pushback against hiking further, or Japan's own 254-day emergency stockpile absorbing some of the pain on timing. The US actually pulled strings to keep this thing from breaking. But even Scott Bessent himself isn't calling this fixed. He said the intervention could only calm things down short term, and that the carry trade itself isn't going away. Here's why that's honest. A 10-year Treasury is paying around 4.7 right now. 10-year Japanese bond is paying you under 3%. That gap is the whole engine of the trade, and one intervention doesn't touch it. So take this as the best real answer we have right now. Not a done deal. I could be wrong about how long it holds. Anyways, here's the part that I think actually matters most if you're trying to invest around this. What if the unwind happens before oil actually spikes here in the US? What if the order goes in and you get this weird disconnect? Forced sellers unwinding the yen trades will dump anything liquid to raise cash, including paper oil futures, even while the actual physical oil is still stuck behind Hormuz. So you could be watching oil future prices flatline or even drop on your screen while the real world shortage hasn't gotten any better at all. That's paper markets lying to you for a few weeks before the physical reality catches back up. And that's exactly why I'm not sitting on UCO ETF for this right now. It's the leverage ETF. It's a 2x daily reset fund. It gets whipsawed up and down hard during the liquidation phase, then has to climb all the way back up once physical shortages reassert themselves. That daily compounding works against you. You can end up losing money on paper even if oil ends up back where it started. USO ETF doesn't have the same problem. It's not leveraged. So it just tracks the price without that decay baked in. So here's exactly how I'm playing this. It's a real position, not hypothetical. Most of my oil exposure right now is in USO, not UCO. On purpose, because that decay risk I just walked you through, I'd rather wait and see which order this actually plays out in before I put a real size into the leveraged version of this ETF. At the same time, I'm sitting on a sizable chunk of cash on purpose, specifically so if that carry trade unwinds actually is confirmed, it's not just talk about it, it's actually confirmed, I can go full into UCO and catch the leverage upside all the way up. So what am I actually watching for the confirmation? Two things. The USD to Japan currency rate and what the Bank of Japan does next. On the chart, 160 has been a battleground level basically all year. Multiple attempts to break above that have failed, and that's exactly where the intervention slapped it back down from. If it breaks through 160 again anyways, that tells you the intervention's already failing to hold the line. On the other side of the 200-day moving average sits around 153.80. A real decisive close below that level is the kind of thing technical guys watch as the first actual sign the trend's breaking for real, not just another bounce. On the Bank of Japan side, their next scheduled meeting is mid-September. But let's be real, they already showed they'll act off schedule if they have to with that intervention. And Japan's not short on ammo either. Goldman's pointing out they're sitting on something like $1 trillion of reserves. Plenty of capacity to step in again. So I'm not just watching the calendar, I'm watching for any emergency action at all. Same as they already did once. If I see the currency rate between US and Japan actually break down through one of those levels and the Bank of Japan step in again, that's my signal. That's when cash goes into work and sizable trades go full on for the UCO. And look, this whole strategy is a bet. It's a bet on Iran does not reopen that strait anytime soon. Honestly, it might be a pretty safe bet. An advisor to Iran's own parliament speaker is reportedly saying they won't even negotiate with this administration at all. They're waiting until Trump's term actually ends in 2029. That's more than 2 years from now. That's not official Iranian policy. It's just one well-connected guy's word. But it's been picked up everywhere. If it holds up, this stops being probably safe bet, and it starts looking like a sure thing. Now, I could be wrong. Things do change fast in this story, but the downside looks really limited. At the end of the day, this is a market that's been coiling instead of breaking. Everybody's expecting it to be already over. It's not, and that actually makes it a better setup, not a worse one. Because now we're actually got real levels to watch instead of just guessing. And lastly, go do your own research. Figure out where you stand on this before you do any type of investing. Don't trust me, just a random guy on YouTube. Investing isn't a sure thing, and sometimes you will most definitely lose money. And as always, good luck, take care, and bye-bye.